What we'll talk about in today's video is how someone plans to use a whole life insurance policy to pay off a large amount of real estate debt. What we're going to do is go over why he's interested in whole life insurance, how he plans to use it specifically to pay off his real estate debt, and then we'll look at the specific illustrations that he plans on using for this strategy. Let's get on into it and have some fun talking about cash value life insurance. So to begin, a little bit of information on the client's profile. He is currently 54 years old. He owns a business. His business does well. It generates about $3.2 million per year. It's done this for several years. He knows what he's doing, and he's quite successful. His personal income, he's got profits from the company that we're estimating right around $800,000 per year. He also has rental properties, which generate about $50,000 per month, which would be $600,000 per year. So his personal take home is about $1.4 million. So he's in the seven figures. He's cash flowing, has done very well, and what he's done very, very well is save his money. So when you look at his assets, you can see cash, savings, money in the bank, currently $700,000. He's got about $1 million in stocks. So that's money in the market. That's just purposed for long-term accumulation. Here's really where he's put his money over the years. He's got a real estate portfolio valued at about $14 million. Now, $3 million of that is his residence. The other $11 million are rental properties that he owns. His business valuation, we've got it conservative at about $5 million. So total assets is close to $21 million. However, he's got some debt, mortgages, mainly on the rental properties, of about $3 million. But if you look at the real estate, it's valued at $14 million. He's got $3 million in debt. Would you say that he's fairly healthy from an equity standpoint? Yes, he is. And the reason why is because he has been taking the majority of this and just pounding away at that debt. His goal is to be debt-free. This way, this cash flow that comes in just comes straight to him. And if he wants to purchase more properties in cash, he can do so. That's what he has been doing for a long time. However, he's been researching whole life insurance, learning about how other real estate investors use whole life insurance, and he wants to see how this can work for him. So what he wants is a whole life insurance policy, but he wants it 1,000% for the cash value. So after we had a discussion, he had sent an email laying out his current situation and what he was interested in with respect to funding a whole life insurance policy, the cash value, and then how he would like to use that policy to pay off debt. So he said, no problem, we'll work on the models. A couple of days later, I get a text message. It says, just to clarify, Steve, I don't really care about the life insurance death benefit. I am interested in getting as much cash value as possible. That's why he's putting money here. No problem. We'll set it up that way. I let him know that because that's how we always set it up. How do we maximize the short-term and long-term cash value so we can use it? So on that point, here's how we maximize the cash value. 3 steps I want to lay out here. Number 1, minimize the base premium. And really what that comes down to is being aware of the limits that are available with the insurance company that I'm opening up my policy with. If I look at any of my 4 major mutual companies, Mass Mutual, Guardian, New York Life, and Northwestern Mutual, you'll see that you can typically set the base premium as low as 10% of the total payment. I'm going to go through an example of that in 1 minute. But step 1, minimize the base premium. Step 2, minimize the death benefit to prevent a modified endowment contract or a MEC from occurring. A MEC is a taxable event with a life insurance policy. It messes everything up. Why a lot of people are attracted to whole life insurance, specifically for the cash value, is because the cash value is a safe place to put money. I can easily access it without any penalties, and if I do it all right, I can access it tax-free. If my policy becomes a MEC, I can't access it tax-free. The gains are taxable as ordinary income, and I might have a 10% penalty tax as well, depending on my age. But that's the second reason, or second step. The third step, maximize the PUA rider for more cash value. PUA stands for paid up additions. I like to call this a cash dump in. Okay, why we do this, specifically step 1 and step 3, minimize the base premium, because the premium does not show up in cash value in the first year. Sometimes it's the first and second year. Now, as you continue to make premium payments, eventually those premium payments build cash value. If you've ever looked at a traditional whole life insurance policy, you likely saw a big premium going in, 0 in cash value in the first year, and then after 10 to 15 years, you finally get your money back. And then you start to see a positive gain. That's usually why people don't like it. But then we've got this paid up additions rider. Why I like to refer to it as a cash dump in is because I see my payment show up in cash value in the first year. It's not always 100%, but a lot of times I'll see 90 to 95% of that PUA payment show up in cash value in the first year. Then a lot of times by year 2, it's positive, and then almost always positive by year 3. So for example, if I said I want to pay $10,000 per year into this policy, meaning $10,000 per year or on any given year is my ceiling. That's the most I'm ever going to pay in. How I would follow these steps is step 1, I would minimize the base premium. If I know the insurance company lets me set that premium as low as 10%, which a lot of the top companies do, that means my base premium would be at $1,000. Step 2, I want to get the least amount of life insurance, which is another name for the death benefit, in order to prevent a MEC. So the IRS still looks at my policy as life insurance. So let's assume for my age, $300,000 gives me a $10,000 MEC limit. The MEC limit is always going to vary based on your age and also if you're male or female, the product and the guaranteed rate. There's a lot of factors that can impact that. Whenever you look at a life insurance illustration though, you can usually see what the MEC limit is, or your agent can tell you. But step 2, least amount of insurance possible based on the total amount I want to pay in to prevent the MEC from occurring. And then step 3, everything above the base premium, I put into PUAs to maximize cash value. Step 1, $1,000 base premium. Step 2, set my MEC limit at my total desired payment. Step 3, put the rest into PUAs because that gives me cash value. Okay, so let's look at his 2 options. And what we just covered there, you're going to see us follow the same model when we look at his policy. So option 1, he said, what if I just keep doing what I'm doing? Which means I don't get a whole life insurance policy right now. And to continue what I've been doing means I would just keep on paying off my debt. And then after the debt is paid, then I can consider a policy. This works. It's what I've been doing for a long time, so I understand it and I'm most comfortable with it. That is an option. We work with people that do this, and if his debt is paid off in 3 years, guess what? We'll follow up with him over the years, and if he decides he wants to pursue it 3 years from now, that works. But if he wants to do it right now, because he understands it, feels it'll be easy, and the numbers make sense, he could get a whole life insurance policy right now. We're going to look at this. Let's lay out the steps, and then we'll look at the numbers. So with option 2, what he's going to do here is fund a policy only for 5 years. During those 5 years, he is going to take policy loans, which will specifically be used to pay off the mortgages he has of $3 million over here. Step 3, while he is taking those loans, the loan balance is going to increase on the life insurance policy. He does not plan to pay it during the first 5 years, none of the loan principal, that is. He's only going to pay the loan interest. So first 5 years, he pays money into the policy, he takes money out through loans, Interest is due, he pays that only. He pays nothing toward the principal. Next step, at the 6th year, he stops paying the premium, and then also at the 6th year, he begins to repay the policy loan. So he is going to now take the money that he was paying toward the premium and PUA rider, toward stuffing the cash value, and just redirect that toward paying the loan. Make sense? Or would seeing this on a chart help? We're going to pull up the chart in a moment. I'm a numbers guy, so it helps me a lot. So before we pull up the chart, why would I do this? In case you're new to all of this, like why on earth would someone flow money through a policy and use that to pay off the debt and then pay the loan on their life insurance policy? I might feel like I'm paying the debt twice. Like, why would I do that? Money that goes into a life insurance policy compounds forever, even when you take loans. Now, it compounds forever, assuming we don't cash it out or take what is called a policy withdrawal. There's a difference between a policy withdrawal and a policy loan. When you take a loan against a life insurance policy, you still get dividends and interest on the money that you've borrowed. So everything that he's paid into the policy for that 5-year period, even though he's going to be borrowing it out, he's still earning interest on it. So if he can stuff a ton of money into the policy over a 5-year period, let it compound while he's using it, now when he pays it back, it's fully restored. And we're going to see exactly how that works. So here's what he wants to do. He wants to fund a policy with up to $800,000 per year for 5 years. That's a total of $4 million. Now, if you see an illustration with $800,000 per year going in, does that mean that you are committed to that $800,000? Do you have to pay it? You don't. The premium is 10%, $80,000. That's what he's committed to. PUAs are optional. Now, I want to add them because that's what grows my cash value. But if I have a bad year and I can't add them, I don't have to. So you can set up a policy to be very flexible. And that right there really loosens the vice grips so people don't feel like I am on the hook to make this big premium payment every month or every year that scares people, especially if they run a business. Yes, cash flow has been healthy for a long time, but things can change, right? Business owners know that, and it's a lot of times just in the back of their mind. I get it. And then the last thing, we'll set the MEC limit at $800,000. All right, so when we look at the strategy, first we're going to review the illustrations and what things look like in terms of growth. And then when we start to leverage the money, we're going to look at the cash value growth and compare that with the cost to borrow. Because what people typically want to see, especially real estate investors, is what is my growth compared to my cost to borrow? And I want to make sure I am not in the red. I don't want to be paying more in loan interest than what my money is growing by. And if I am, I just want awareness, and then I want to be aware of how I can quickly get myself out of that situation. So let's take a look here. What we're going to start with is the illustrations. We'll look at the PDFs very quickly. This way you can see them on the insurance company's illustrations, and then we'll transition into the Excel workbook. So this is MassMutual, one of the 4 major mutual companies, which we looked at MassMutual and Guardian in his particular case. So as we look at the funding here, he's got a total of $800,000 per year going in. Okay, $800K per year going in. If that amount goes in, the question I would ask here is, where is my money going? Because what we just went over is what? It can go toward the premium or the PUA rider. Here's your premium, $80,000. $80,000 is what percentage of $800,000? Yeah, baby, you see where I'm going here? 10%. Minimize the premium to maximize the cash value. Now he pays in $800K. There's the cash value in the first year, $711,000. That, by the way, is the worst part of any life insurance policy, the first year, where we take that negative hit right out of the gates. The best part is every year after that. But you've got that $800K going in. Minimum premium is $80,000. Last thing I want to hit on this, your death benefit is what? $9 million. Kind of an oddball number when we really look at it, $9,030,000. Where do we come up with that? You would follow me to the bottom right-hand corner. What do you notice here? MEC limit, $800,000. What has a direct relationship to the MEC limit? The death benefit on a life insurance policy. So that $9,030,000 just represents the minimum amount of life insurance we needed to give him an $800,000 MEC limit. Because if you minimize the death benefit, you minimize the costs. Minimize the costs, you get more cash value. So that is our Mass Mutual illustration. Let's take a look at our Guardian illustration. Here we go. Okay, so same thing, 54-year-old, $800K per year going in. Guardian, here's your premium. So it's actually less than 10% because we're stretching it as much as we can here. What you'll notice is the amount going toward the PUA rider is 10x that, 10x the base premium. How this policy would be set up if he says, I want to go with Guardian, is he would be billed for this, plus this, and then this is optional. This way he can commit to about $80K per year and then have the option to add up to $80,000 up to $800,000 per year. Make sense? This is what we like to refer to as pushing the envelope, meaning maximize everything. So let's look at this illustration, shall we? We're going to look at it on Excel, and I want to go through some commonly asked questions here. These will hopefully be valuable just as I walk you through this exercise. So there's your funding, $800K per year. There's your premium, $80K. There's your PUA payment of $720. The true minimum is a bit more than this when we factor in the term rider, but we're using round numbers for this example. So this provides a clean breakdown as to where our money is going. Next, total payments. I always like showing this column because when I was new to all of this, this column helped me a lot just tally up all of the annual payments I made, and then I could really just see when my cash value exceeded my total payments. It helps me see my break-even point with ease. I don't have to sit there and try and calculate it myself. That's why we like including the total funding column. The cash value represents your money column. Okay. What's the worst year when you look at this? The first year. You have less than what you paid in. We're going to look at this in a second with respect to the returns. But there's our death benefit. What jumps out at you here? Anything regarding the death benefit? How about this? See that drop off there? Happens at year 8. The reason why. Another name for our MEC test is called our 7-pay test. This has to do with the first 7 years on a life insurance policy. Without getting into the weeds of it, if we reduce the death benefit during the first 7 years, we'll trigger a MEC. If we do it in year 8 in this example, especially where he wants to stop payments early, we don't trigger a MEC. And the reason why we are dropping the death benefit is because reducing the death benefit reduces the cost, which allows the cash value to grow at a faster rate, which is what he's interested in. And this, by the way, is not something that you need to declare up front when starting the policy. This is an after-the-fact change. So if you already have a policy and say, mine wasn't set up like that, no need to worry at all. This is a change that can easily be done after the fact. But if you plan to keep on paying, you might want to keep that term rider attached. You can look at illustrations to see if it'll mech or not. Okay, here's what I want to hit on. The dividend rate is for 2025, by the way, 6.4%. When you see a dividend rate of 6.4%, what do you naturally think your cash value is going to grow by? 6.4%. That's what I would think. If you're in the industry or have some experience with this, you know that that's not the truth. And that's a reason, that is the reason I put the word gross in there, because it's a gross rate. It also might feel gross. I want to throw up when I think I'm going to get 6.4% and I find out it's only 5%, unless it was laid out up front to me, meaning it was made transparent. So if we want transparency, what we can look at are two things. If you want to see the yearly rate of return, we can just plug that into an Excel workbook. You can also request this from your agent, and you can have it included on the life insurance illustration from the life insurance company that you're considering. Most companies will include this. Mass Mutual, for example, does. But when we look at this, annual rate of return, the first year is negative 11.09%. The reason why is because you paid in $800,000 and you have $711,000. You have less than what you paid in. The second year, negative 1.88%, not 6.4%. The reason why is because in the first year, you had $711,000. In the second year, you added $800,000. What is 711 plus 800? It would be 1.511. What is the cash value in the second year? Less than that number, which means you did not even get all of your $800K back. So in the first and second year, I take a loss on that. That must be disclosed upfront and be made as transparent as possible. You wouldn't believe how many people get into whole life insurance products thinking that they have a positive return on their cash value in the first year. Sometimes it's because it was spun to them in a manner that, hey, in the first year, you started out with $700K, and then by the end of the year, you have $711. You gained $11,000 that year. They didn't. It may have grown by 11 over the course of the year, but you still lost almost 90 grand there when I look at what I paid in compared to what my value is over that full year. My point is, just looking at the numbers at the end of each year will help paint a clear picture of what the net value is. Now, after the second year, it starts to pick up. Gets better and better. You'll notice when I stop paying, there's a nice little jump in the growth rate. That's common. If you're wondering why, please drop a note in the comments and I'll be sure to respond to you. And then next, you see a nice little jump in year 8 when we drop that death benefit. Check that out. Drops even more. Increases even more. And then look, another increase. But wait, there's more. Another increase after year 10. The reason why is because this is a 10-pay policy and the premium is due for 10 years. We're not paying it, but that's how long it's due. When it's no longer due, we see a nice little bump in the growth rate, which is pretty nice. So this is what it's growing by net every year. This is the yearly rate of return. And remember, if you do everything right with a life insurance policy, we've got those tax benefits, which is very beneficial, meaning you can use it tax-free. So how valuable is a 5 to 5.5% tax-free growth rate, especially if we're comparing it to something that's taxable? But that's the yearly rate of return. And then we've got the internal rate of return. The first year, it's negative 11.09%. But the IRR, if you're in real estate, you likely know what this is. If you don't, it's a fancy way of calculating the average. It's just taking into account when we made those payments. But there's the average IRR, gets stronger and stronger over time, but it's really making up for that first year. So those are percentages. A lot of stuff. Now, if you think that that's confusing, because it can be in many cases, a different way you could look at it is in terms of dollars. So what you can look at is the annual growth, which is the same thing as the annual rate of return. The difference is now we're just going to look at it in terms of dollars. So negative 11% comes out to negative $88,000 and change. So we can see what that is in terms of dollars. And then as time passes, we see how much it's growing by every year. And just to be clear, what this is showing is the net dollar amount you're getting from the insurance company. We backed out our payments. So it's showing what you're getting every year, which is nice. And then instead of the IRR, you can look at what is called the total gain on cash value. Okay, so that provides a nice picture of what the policy is growing by. We spent a lot of time on that, and the reason why is because if we go back to what he wanted to see, what was it? Cash value growth compared to cost to borrow. I want to see what it's growing by and then compare it with what I'm paying in loan interest. Let's look at that right now. So on our loan workbook, which will match a life insurance illustration that we would run showing loans, what we're going to do is build out a live loan model. So what we've got here is as follows. Here we've got the illustration, $800K per year for 10 years. There's your growth rate, which is the annual rate of return. Okay. This column, LTV at 95% of cash value. What is that? LTV means loan to value. This displays the maximum loan you can borrow against this policy. In most cases, regardless of the company you select, you will see that the maximum loan you can take is usually right around 95%. Sometimes a little bit higher, sometimes a little bit lower, depends on how that company bills loan interest, if it's upfront or over the course of the year. What was his plan? Do you recall? Well, his plan was to take loans for the first 5 years and pay off that $3 million in debt. So we're going to do that, but before we do that, one last thing I want to hit on. Yearly comparison, yearly cash value growth shows what you are getting from the insurance company every year. Annual interest payment shows what you are going to pay to the insurance company every year. And then spread is going to show, are you positive or negative? And let's get these colors correct. All right, so his plan, take loans for the first 3 years, first 5 years to pay off that debt. What we're going to do is take loans of $600K per year for 5 years. Just makes it simple. He would actually do it a bit faster than this because he can. Like in the second year, he can take a maximum loan now of $800,000. But we're going to take $600K per year for 5 years. What do you notice here? We plugged in those loans. Your LTV dropped. That displays the maximum you can borrow. When you took these loans, there's your cost to borrow. This is MassMutual's December loan interest rate, December 2024. There's your loan balance. Here's the loan interest. That's the annual amount. and we are assuming that he is paying it every year. If you take a loan in the first year, is it ever going to be beneficial from a number standpoint? Not factoring in where you put it, just based on the policy. No, because you already have a negative spread if you just do nothing, meaning you take a loss. So if we add an interest cost on top of that, what's going to happen? Well, now that spread is even worse. So when we look at this, what we like to look at here is how many years am I negative? And how much am I negative by? He's negative for the first 5 years, which is when he's funding it. And he has to be comfortable with this to do this strategy. A lot of people wouldn't. Like, why would I take a loss? You'll see why in a moment. You might see it already. But he takes this loss. That's your true spread there. Like, look at year 5. Loan balance is $3 million. You earned 3.24%, but it was on $4.1 million. You paid 5.1%, but it was on $3 million. That's why that spread is pretty close. You gained about 130, you paid 153. The next year, we're assuming you carry that $3 million loan balance. The interest, we're assuming, is the same. You pay $153,000 in loan interest that year. What did your money grow by? $191,000. Now, all of a sudden, you have a positive spread. If he's able to make any loan payments during the first 5 years, if he says, hey, I just sold a piece of property, I can throw $300K at this loan principal. Look what happens. Makes his numbers more favorable. This is where this workbook helps a lot. And you don't need the workbook. You can run it in the life insurance illustration software as well, or your agent can do it for you. But let's pay this off now. So we're going to apply $500K per year toward the principal, since right now his real estate is producing $600K per year. He's going to use it to pay off the properties, or pay off the policy loan here. We set it at $500K per year toward the principal because we're still paying the loan interest out of pocket over here. But once you start chipping away at that loan, there's $500K. Loan balance is coming down every year. There's your loan interest, less and less. But your growth doesn't slow down. It keeps on getting stronger and stronger. So that spread becomes more and more favorable. So this right here is what he's looking at and saying, okay, the upfront cost is really not that bad in his particular situation, especially when I factor in what I'm getting long-term. And I know that if I can cash flow $4 million through this policy and I don't cash it out or cancel it, that's going to compound for me indefinitely. So I can aggressively save for the next 5 years, use the money to clear my debt, and then when the debt is cleared, I'm going to use the asset, the real estate, to then pay off the policy debt. And now I've got the real estate that's still cash flowing, plus this policy that keeps on cooking. And lastly, he plans to use this for, guess what? More real estate in the future, which is fun. All right, last thing that, if I'm you, I would ask for here is, what is the total cost to borrow compared to the total gain on the policy? So what we've got here, same thing with more columns. I'm going to condense the death benefit. Let's duplicate our loans, 600K. Pretty cool, right? All right, so I'm going to get rid of the yearly comparison here, just to make this easier to follow. And we're going to look at the total. So what this is going to show is your total gain on cash value, and then the total interest you paid over time, which is pretty nice, isn't it? Because what I'm looking at here is the same thing I'd see if I said, hey, can I see the total interest I paid to a bank on a 30-year mortgage? And then you find out it's way higher than the 3.25% interest rate you have in your mortgage. You ever see anything like that? So this helps us here where I can see the total interest with this $3 million loan. We paid $840,000 in interest. Why he did that though is because it was offset with what he earned in dark blue here. And the spread is just going to show when your gains exceed your total interest paid. So in this case, 8 years, he's 54 now, so that'll be when he is 62. It's just about a wash, and then it just keeps on compounding over time, where that spread is more and more favorable. Because when the loan's paid off, the interest is fully paid. There's no more interest to be paid, I should say, but the cash value keeps on compounding. So that's why he did it. This is why a lot of people do it. I hope that you enjoyed the detailed breakdown. If you don't like the numbers, but you like the strategy and just prefer for us to do it for you, there are a lot of people we work with that do that more or less just say, hey, tell us what we should do. Recently had a meeting with a couple we've worked with for about 5 years now that said, hey, we've got X amount of dollars that we want to dedicate toward both of our policies. Here are our loans. Here's what our premiums are. Here's the maximum we can add in terms of additional PUAs. With this dollar amount, tell us where you would put it. We'll take the details, but just tell us where you would put it. And we did that, and they did exactly that. So I do hope that you enjoyed this video. If you have any questions at all or thoughts or case studies you'd like to see, please feel free to leave them in the comments below. And as always, I hope this helps.